Welcome to the Deep Dive. Today we're taking a deep cut into the Q4 fiscal year 2025 earnings briefing from Apple.
Which just dropped yesterday, October 30th.
Exactly. And our mission today is really to filter out the essential intelligence from that conference call.
Right. We need to dissect the numbers, the guidance.
And those, the big strategic shifts that caused that immediate positive pop in the stock price.
Yeah, the market reaction was definitely swift. And, well, for good reason. What investors heard wasn't just, confirmation that Apple's managing the macro stuff.
Right, that they're weathering it.
But that their core strategic moves, think services, think AI investment, they're actually accelerating.
Okay. So we're looking beyond just the headlines here.
Yeah, trying to see what this clean beat and that very optimistic holiday guidance really signal for this, well, $3 trillion plus giant.
Let's kick off with the snapshot then, because these results, they set September quarter records pretty much across the board.
They really did.
The headline figures weren't just a beat. They felt like a statement of momentum heading into the holidays.
That's exactly the key takeaway. A record September quarter, period. Total revenue hit $102.5 billion.
Which is 8% year-over-year growth.
Yep. And it cleanly beat the consensus estimates by, about $200 to $300 million?
And the profit side looked even better, didn't it? It wasn't just growth for growth's sake.
No, far from it. GAAP EPS, that came in at $1.85.
Okay.
That's a 13% adjusted increase year over year, another record for the September quarter. And it beat the analysts by about 7, maybe 8 cents.
And the gross margin, that stood out.
Oh, absolutely. Structurally, that's fascinating. 47.2%.
Wow.
That's a big jump, like 100 basis points improvement over last year. It really suggests that intentional shift they're making.
Towards services and premium phones.
Exactly. High margin services, premium device pricing. It's paying off, like right now.
Yeah. Okay, so let's unpack this. Let's look at the segment drivers. Services has been the story for years, but it feels like it's hitting another level now.
Monumental is probably the right word. Services revenue hit an all-time high, $28.75 billion.
And growing fast.
Growing 15% year over year. And the strength wasn't just one thing, it was broad. New records, all-time records for the App Store, iCloud, ads, payment services, even video.
Right. They threw in that stat about Apple TV Plus getting 22 Emmys.
They did. Just a little reminder that the content strategy is actually working,
Yeah.
And the overall scale just crossed a huge milestone. Total fiscal year services revenue, over $100 billion for the first time ever.
$100 billion.
Yeah. And think about that 15% growth rate on that base size.
Yeah.
Plus those gross margins, 75.3%.
75% margin.
That's what funds everything else. It's literally the financing engine for that massive AI push we're seeing.
Okay, but speaking of that 75.3% services margin, that number is almost, unheard of in tech manufacturing.
It is incredibly high.
Doesn't that also paint a massive regulatory target on their back? I mean,
Yeah.
How do they handle the questions about antitrust scrutiny? That hits right at the core profit engine.
Well, they didn't dwell on it directly, But the structural argument they seem to be making is that this growth comes from innovation across lots of different areas.
Not just the App Store.
Right. By highlighting growth in advertising and payment services and those Apple TV Plus wins, they're trying to show that the services flywheel has many parts. But you're absolutely right. Every point of margin improvement probably adds to that regulatory risk premium the market has to factor in.
Okay, let's shift gears to iPhone. Revenue there was $49.0 billion, up 6% year over year, another September quarter record.
Yep.
But the real kind of jaw dropper here is the demand story underneath that number, isn't it? Because the timing of the iPhone 17 launch makes that $49 billion a bit misleading.
Oh, extremely misleading, that 49 billion figure.
Yep.
It only included about 1 week's worth of sales for the new iPhone 17 family.
Just 1 week.
Just 1 week. So the demand signal, especially for the fancy ones like the 17 Pro and the new iPhone Air, it's actually much stronger than that Q4 number suggests. Management was really quick to point out they had a record number of people upgrading their phones during the quarter.
Which feeds the ecosystem.
Exactly. It pushed the overall active installed base to an all-time high across all their product categories. And that installed base, that's the foundation for everything else they do.
Right. Moving on to the rest of the portfolio, Mac looked pretty good. iPad and wearables, maybe less exciting.
Yeah, Mac revenue was a definite upside surprise. $8.73 billion, up 13% year over year.
Why the strength there?
They said it was the continued success of the MacBook Air lineup and also the buzz around the new M5 chip announcements.
Ah, the M5.
And this is important for you listening. The M5 chip, they specifically said it has like 3.5 times faster AI performance than the previous one.
Okay, so that's management clearly signaling the hardware upgrades are tied to AI features coming down the line.
Precisely. It's not just about faster chips anymore. It's about making the hardware ready for these new, like, on-device AI tasks.
Future-proofing the ecosystem, basically.
Exactly.
Yeah.
Meanwhile, iPad, $6.95, and wearables, home, and accessories, $9.01. They were both roughly flat compared to last year. Wearables saw good demand for the watch and AirPods, apparently, but it got offset by some tough comparisons in the general accessories category from the year before.
Okay, so Q4 numbers are done. History. What the market really jumped on was the forward guidance, right? The FQ1 holiday outlook.
Oh, yeah. And that forecast was incredibly bullish.
They gave an explicit outlook that just screamed confidence.
You really did. Management guided for total company revenue growth of 10-12% year over year for Q1.
Which would easily be an all-time record holiday quarter.
Comfortably. But the real headline in the guidance was the explicit forecast for double-digit iPhone growth.
That's specific.
That's specific. That level of detail signals massive faith that this iPhone 17 cycle is going to keep running strong right through the end of the year.
And margins holding up too.
Yeah, they expect gross margin stability, guided between 47% and 48%. Very strong.
We have to talk about the geographical headwind, though.
Yeah.
Greater China revenue was down 4% year over year in Q4.
Right.
Now, management blames supply constraints for that. Is that really believable, though, given how intense the competition is over there? Are investors actually buying that story?
It's a compelling piece of management spin, let's say, but they did try to back it up operationally.
How so?
They were pretty adamant that the decline year over year was mainly due to specific ongoing supply issues they had with iPhone 16 and 17 models, not because demand was weak.
So saying demand is fine, they just couldn't make enough phones.
That's the claim.
Yeah.
And they explicitly said they expect a return to growth in Greater China in FQ1, citing the, quote, tremendous reception of the new iPhone 17 family. They even threw in that store traffic was up significantly year over year in China, suggesting demand is healthy, but was just unfulfilled in Q4.
And the market bought it.
For now, yeah. Given that super strong FQ1 overall guidance, investors seem willing to accept that narrative, at least for now.
Okay, so this record guidance, this aggressive confidence, it comes with a cost, right?
Yeah.
Operating expenses are climbing sharply.
Yep. That's the financial side of this AI arms race we're seeing.
You can see it right there on the balance sheet.
Absolutely. Operating expenses, OPEX, hit $15.9 billion in Q4. That's up 11% year over year.
And looking ahead.
The FQ1 guidance is where it gets really interesting. OPEX is projected to jump again significantly, somewhere between $18.1 billion and $18.5 billion.
Wow. And that's mostly R&D?
The vast majority of that increase, yes, is driven by R&D. It reflects this absolutely colossal investment they're making in artificial intelligence.
What specifically are they spending on? We should probably explain some of these terms for the listener.
Okay, yeah. They confirmed they're developing the private cloud compute, or PCC.
PCC.
Basically, think of it as Apple building its own custom server infrastructure, the physical backbone they need to deliver these fast, personalized AI features without having to rely on, say, Google Cloud or AWS.
So they control the whole stack.
That's the goal. They even mentioned new manufacturing for these servers is kicking off in Houston, and this R&D spend is also fueling the actual user features, things like Apple Intelligence.
That includes
things like live translation, Workout Buddy, visual intelligence, and they said they're still on track for that big, more personalized Siri update that's expected next year.
Right.
So the message is clear. They're spending big to own everything from the chip, the M5, to the cloud, the PCC, right up to the software features.
Okay. Before we tie this all together, just a quick mention of tariffs. That's still a factor, right?
It is. Baked into the results, tariffs cost them about $1.1 billion in Q4.
For Q1.
The projection is a bit higher, $1.4 billion. But interestingly, that $1.4 billion figure already includes a recent positive policy change in China.
Oh.
Yeah, where some tariffs apparently got adjusted down from 20% to 10%. So while the total cost is going up, the rate of increase was actually helped a bit by policy.
Got it. Okay, so zooming out, connecting the dots for everyone listening. We got a record quarter, massive forward guidance, huge R&D spending. Why is this combination structurally so important for Apple's long-term story?
It really all comes back to the ecosystem's durability. That all-time high installed base, it creates incredible stickiness.
Meaning people stay with Apple.
Right. It means when they launch a new device, that upgrade cycle is pretty predictable. And this sticky ecosystem, it's the main engine funding that services growth, the ARPU growth.
ARPU being average revenue per user.
Exactly. And crucially, it lets the company absorb and manage temporary bumps in the road, like that Q4 China softness we talked about, because the user base is just so committed globally.
And the immediate financial payoff is that profit mix shift you mentioned earlier.
Precisely. They're intentionally tilting the whole profit engine towards those high-end premium devices and, maybe more importantly, those super high-margin services. Remember that 75.3% gross margin?
Hard to forget.
That shift is what's structurally supporting the overall fantastic gross margin performance, even with rising tariffs and that heavy R&D spending.
And finally, capital allocation. Still returning cash to shareholders.
Oh, yeah. The board declared $1.26 per share dividend, and Q4 saw a huge return of capital. $24 billion went back to shareholders.
$24 billion.
Including $20 billion just buying back their own stock on the open market, 89 million shares. They ended the quarter with a net cash position of $34 billion. So yeah, the capital return story is rock solid.
Okay, now it's time for the segment where we put on our metaphorical aggressive hedge fund analyst hats. We call this is not financial advice.
Right. We're pitching an outrageous but maybe plausible trade idea based strictly on the details we just pulled from this earnings call.
So what's the angle? Where did management give us maybe two slightly conflicting signals?
Okay, so the overall long case seems pretty clear, right? Driven by that explicit double-digit iPhone growth guidance for Q1, plus the services records. Very bullish. But management also gave a very specific warning. They mentioned facing a very difficult compare on the Mac segment in Q1.
So overall bullish, but there's this tactical risk hidden in one product line. Mac might miss expectations short term.
That's the potential vulnerability. So the pitch is a long AAPL short Mac supplier pair trade, notionally, of course.
Okay, break that down.
You buy Apple stock or maybe long-dated calls, betting on that huge iPhone 17 wave and the service's profitability. You're leveraging the overall strong story, the $4 trillion market cap buzz, whatever.
Go long Apple. And the short side.
Concurrently, you look to short the stock of a company that's heavily concentrated in providing Mac-specific components or maybe assembly services.
Shorting a supplier who depends on Mac sales. Why is that Mac compare so tough again?
Because last year's Q1 for Mac was, quote, the mother of all Mac launches. They had the MacBook Pro, the Mac Mini, the iMac all hitting the market basically at once.
Okay, huge quarter last year.
Huge. This Q1, they're only comparing against a single 14-inch MacBook Pro launch from last year. That difficulty in comparison creates a segment-specific headwind.
Which the huge iPhone guidance might mask at the total company level.
Exactly. So the pair trade, in theory, isolates you a bit from macro shocks, while letting you capitalize directly on management's own warnings about the Mac category's difficult path just ahead.
A tactical short, playing off a specific warning, hedging against that overall structural long thesis. That's clever, pulling that right from the call's details.
But again, let me stress, this is not financial advice, just an analytical exercise.
Absolutely. So to recap for everyone, you just got the essential intelligence from Apple's record September quarter, driven by unprecedented services momentum and the strong start for the iPhone 17.
And that success is being plowed right back into massive R&D spending thing, private cloud compute, Apple Intelligence, all supporting that highly optimistic holiday guide, 10 to 12% revenue growth.
Right. Our provocative thought for you to mull over is this. Management is seriously ramping up operating expenses. Huge R&D on AI. The M5 chip, that PCC infrastructure.
So the question is, if this massive investment actually pays off in, say, 2026, with genuinely game-changing, exclusive, personalized AI features on the device, how fundamentally does that lock in the ecosystem even tighter?
And does that proprietary AI future justify Apple consistently flirting with a $4 trillion market valuation?
That R&D spend, that's the really long-term bet they're making.
Indeed. Thank you for joining us for this deep dive. We hope you feel thoroughly briefed and ready for whatever comes next.
Until next time, keep learning.